On February 6th, the silver market delivered a move that should have immediately triggered alarm bells across the financial system. After days of extreme pressure, forced liquidations, and violent downside moves, silver didn't stabilize. It didn't drift sideways. It snapped back with force. The kind of force that doesn't appear in healthy markets. What you're about to hear is not being explained honestly in mainstream coverage, because this wasn't just a rebound. It was a stress response. Before we go any further, if this kind of breakdown matters to you, hit like and subscribe, because what you're about to see doesn't get explained honestly anywhere else. Here's what most people missed. The selling that hit silver wasn't driven by a sudden collapse in demand. It was mechanical. Margin pressure rose, liquidity thinned, positions were forced out at speed. When that happens, markets don't reward conviction. They reward balance sheets. Smaller participants scramble. Larger institutions wait. And while most eyes stayed glued to the price chart, something far more important was unfolding underneath. This rebound arrived before confidence returned. It arrived while fear was still raw, and it arrived while most participants were still trying to understand what just hit them. That timing matters. Violent rebounds like this don't signal relief. They signal transfer of risk, transfer of exposure, and transfer of control. When leverage breaks, markets don't reset politely. They reset violently, and only after weaker positions are cleared. And that's where one name keeps appearing: JPMorgan. Not because of rumors, not because of internet narratives, but because of scale, exposure, and history. As silver snapped higher, reports and positioning data pointed to major institutional repositioning. At the same time, retail participants were being forced out. Large banks had the flexibility to absorb volatility, restructure exposure, and wait for pressure to do the work for them. This is not an accusation, it's structure. Large institutions do not experience volatility the way individuals do. They don't face the same margin calls. They don't have to react at the worst possible moment. When markets fracture, they reposition. And that distinction is everything. If this rebound were just a temporary bounce, pressure indicators would have eased. Physical demand would have cooled. Volatility would have faded. But that's not what the signals show. Stress hasn't disappeared. It's shifted, which tells you something critical. The system hasn't healed. It's adjusting. Focusing only on price right now is dangerous. Price shows you where the market has been, not who was forced to sell, who stayed in control, and who emerged positioned differently once the dust settled. That information lives in exposure data, delivery behavior, and institutional balance sheets, not headlines. And here's the part most people aren't ready to hear. When rebounds happen under these conditions, they don't mark the end of risk. They mark the end of complacency. After leverage is flushed, markets don't become calmer. They become sharper. Smaller flows move prices faster. Mistakes get punished harder, which means what you saw on February 6 wasn't resolution. It was a signal that the pressure inside this system reached a level high enough to force change, a signal that control shifted quietly while most people were still watching the chart, and a signal that silver is reflecting stress far beyond its own market. This move wasn't random, and it wasn't the end of the story. But before you decide what this rebound means, you need to understand why it matters far beyond silver prices. Because what comes next doesn't just affect traders. It affects savings. It affects retirement. And it affects anyone relying on stability in a system that just showed you how fragile it really is. But first, you need to understand. At first glance, what happened in silver looks like a trader's problem. A volatile asset, a sharp drop, a fast rebound. Something only people watching charts all day need to worry about. That assumption is exactly what makes this moment dangerous, because moves like this don't stay contained. When a market can erase massive value in days and then rebound violently without warning, it's not just showing volatility, it's exposing fragility. And fragility doesn't stop at commodities. It moves outward, into savings, retirement plans, pensions, and purchasing power. If you're holding cash, relying on long-term investments, or trying to protect yourself in an environment where inflation never really left, this matters to you whether you own silver or not. Here's why. Silver sits in a unique position inside the financial system. It's not just a speculative trade, it's not just an industrial input. It's both, and it's heavily financialized. That means it's traded aggressively through futures, options, and derivatives, while also being demanded in the real world for energy, technology, and manufacturing. That combination makes silver one of the first places where stress shows up when something inside the system starts to strain. When liquidity tightens, silver feels it. When leverage breaks, silver reflects it. When confidence wobbles, silver reacts violently. That's not coincidence, it's function. And when silver behaves erratically, It's rarely isolated. It's usually signaling pressure somewhere else, pressure that hasn't fully surfaced yet. This is where the personal impact becomes clear. Institutions don't experience volatility the way households do. Banks and large funds have buffers. They have access to liquidity. They can hedge, restructure, and wait. Most people can't. When volatility explodes, smaller participants are forced into decisions at the worst possible moments. Selling doesn't happen because people change their minds. It happens because they run out of room. That's how losses get locked in. History has shown this pattern repeatedly. During past periods of financial stress, sharp moves in silver appeared alongside broader instability, not because silver caused the damage, but because it reflected it early. Debt expansion, currency pressure, and leverage all tend to surface in markets like this before they're acknowledged elsewhere. What makes the current environment more concerning is scale. The system today is far more interconnected than it was in previous cycles. Derivatives exposure is larger, debt levels are higher, liquidity depends heavily on confidence staying intact. When confidence breaks, even briefly, the response can be disproportionate. That's why moves like this feel sudden and overwhelming. This is also where the imbalance between retail and institutions becomes impossible to ignore. When margin requirements rise and liquidity thins, who is more likely to be forced out? Someone with a trading account or someone with access to billions in funding? Who feels panic first? A household watching retirement balances swing or a bank managing exposure across multiple books? The system isn't neutral in moments like this. It's structured. And that structure determines who absorbs the shock and who transfers it. That's why these events always feel one-sided in hindsight. It's not that one group is smarter. It's that one group has flexibility and the other doesn't. And once you see that, this stops being a story about price. It becomes a story about power. Power over timing, power over exposure, power over who is forced to act and who gets to wait. This is where the uncomfortable question starts to form. If these same dynamics appear again and again, leverage building, pressure rising, weak hands exiting, strong hands remaining, then these aren't random market accidents. They're predictable outcomes of how the system is designed to function under stress. And once you recognize that, you stop asking whether this move was justified or excessive. You start asking who benefited from it, because someone always does. And to understand that fully, we need to look directly at the institutions that sit at the center of these moments. Not in theory, but in practice. That's where we go next. To understand why this silver move unfolded the way it did, you have to look beyond charts and headlines and focus on one institution that consistently appears whenever this market enters extreme stress. JPMorgan. Not because of rumors, not because of online narratives, but because of scale, exposure, and history. JPMorgan isn't a casual participant in precious metals. It is one of the largest and most complex players in silver derivatives, operating across futures, options, and structured products. That level of involvement doesn't mean a bank controls price. It means the bank is deeply embedded in how risk moves through the system when volatility hits, and that distinction matters. Large institutions don't approach silver the way individual investors do. They're not trying to predict day-to-day price moves. They're managing exposure across cycles. Their priority isn't being right about direction. It's surviving disorder and remaining positioned when others can't. That's why reports of large, unrealized losses tied to silver derivatives deserve attention. Not because losses imply failure, but because they signal scale. When stress surfaces inside an institution of that size, it tells you volatility reached a level high enough to penetrate even the most fortified balance sheets. But here's where most people misunderstand what that means. An unrealized loss is not the same thing as panic. It doesn't mean a bank is trapped or cornered. Large institutions have multiple tools that simply aren't available to smaller participants. They hedge, they restructure exposure, they offset positions across books. And crucially, they don't face margin pressure the way retail traders or smaller funds do. That asymmetry is built into the system. When volatility spikes, retail participants and leveraged funds are forced to react. Positions are liquidated, exposure is reduced under pressure, losses are locked in. Institutions, by contrast, can wait. They can allow the market to do the work of clearing weaker positions while they manage risk internally. This is why JPMorgan's name repeatedly surfaces during silver dislocations. Not because the bank causes volatility, but because it sits at the crossroads of it. When leverage built elsewhere breaks, the shockwaves inevitably pass through the largest participants connected to the market. History reinforces this. Over the years, JPMorgan's precious metals exposure has been examined by regulators, lawmakers, and analysts, not always with findings of wrongdoing, but with consistent concern over concentration. When too much exposure flows through a small number of balance sheets, volatility doesn't disperse evenly. It amplifies. And amplification changes incentives. A violent sell-off shakes confidence. It forces selling. It resets positioning. For some, that's catastrophic. For others, it's opportunity. Institutions with staying power don't need calm markets. They need resolution. They need pressure to remove excess leverage so price discovery can function again. That doesn't require coordination. It doesn't require conspiracy. It's mechanical. Markets built on leverage always unwind the same way. When conditions tighten, the weakest links break first, and once they do, control shifts quietly to those who can withstand the chaos. This is why focusing on whether a bank won or lost during this move misses the point. The real signal isn't the profit or loss itself. It's the fact that stress reached a level high enough to force repositioning across the system. And that tells you something important. This wasn't a superficial shakeout. It wasn't noise. It wasn't a random overreaction. It was structural stress expressing itself through one of the most sensitive markets in the system. But to fully understand why these patterns keep repeating and why silver behaves this way at critical moments, we need to step back even further. Because this exact sequence has played out before, more than once. And every time it does, it leaves behind the same clues. To see them clearly, we need to look at history. What's happening in silver right now feels extreme because it's unfolding fast, but the structure behind it is familiar. In fact, this exact sequence has appeared again and again whenever silver reaches moments of real stress. To understand the present, you have to recognize the pattern. Let's go back. In past cycles, silver didn't fail quietly. It broke violently. Sharp advances were followed by brutal collapses that convinced most participants the story was over. Confidence vanished. Headlines turned negative, and just when conviction was weakest, the market reset and moved again in ways very few expected. One of the clearest examples came during the late 1970s silver boom. After an explosive rise, silver collapsed hard. Prices were cut nearly in half. Commentators declared the market finished. Traders who entered late were wiped out, but once forced selling was exhausted and leverage cleared, silver didn't stabilize slowly, it surged. The violence wasn't the end, it was the reset. The same structure appeared decades later during the global financial crisis. Silver was crushed alongside nearly every other asset. Liquidity vanished. Futures collapsed. On screens, it looked like failure. But beneath the surface, physical demand told a different story. Once panic selling ended, silver recovered aggressively and went on to reach levels few believed were possible during the crash. These moments weren't coincidences. They followed a repeatable sequence. First, leverage builds during rising prices. Confidence grows. Risk expands quietly. Then something shifts. Liquidity tightens. Margin pressure increases. Volatility accelerates. And suddenly participants who relied on borrowed exposure are forced out. That's when the break happens. Prices fall not because fundamentals disappear, but because positions must be liquidated. Selling becomes mechanical. The market overshoots. And once enough leverage is removed, pressure stops building downward and begins shifting upward. This is the part most people miss. The most violent price action usually doesn't mark the end of a trend. It marks the reset that allows the next phase to begin, but only after control changes hands. What makes the current situation more dangerous is how much larger and more complex the system has become. Silver today is far more financialized than it was in earlier decades. Paper contracts dwarf physical supply. Derivatives amplify exposure. And global demand is no longer concentrated in a few regions. It's spread across industries, currencies, and supply chains. That means when stress hits, the system doesn't absorb it smoothly. It fractures. And fractures reveal weaknesses that don't show up during calm periods. Another historical parallel worth understanding is how silver behaves when confidence in institutions erodes. During periods of monetary uncertainty, silver often becomes a battleground between paper promises and physical reality. Prices swing wildly on screens, while real metal remains difficult to source. That divergence isn't accidental, it's structural. We're seeing similar signals now. Sharp paper sell-offs followed by fast rebounds. Persistent volatility, continued signs of physical tightness. These are not features of a market that has healed. They're signs of a system trying to rebalance under pressure. History doesn't repeat in perfect detail, but it does rhyme. And the rhyme here is clear. When silver collapses violently without a corresponding collapse in real-world demand, it usually means the market isn't breaking down. It's being reorganized. That doesn't make the process safe. Resets are painful. They transfer risk. They punish those who are forced to act and reward those who can wait. And they often happen faster than most participants can process. This is why looking only at today's headlines is misleading. Every major silver dislocation has looked chaotic in the moment. Only later does the pattern become obvious. And that pattern has one consistent feature. After the reset, the market doesn't return to normal. It reprices. Sometimes that repricing takes time. Sometimes it happens abruptly. But it always follows the same prerequisite. Excess leverage must be removed. Weak positions must be cleared. And confidence must be shaken enough that participation thins out. We're in that phase now. And to understand how far this process has gone and how much pressure still remains, We need to look directly at the data beneath the price. If this move in silver were just noise, the data would confirm it. Volatility would fade, pressure would ease, the market would quietly move on. That's not what the numbers are showing. In fact, when you look beneath the surface, the data tells a story that directly contradicts the idea that this was simply a crash followed by a harmless rebound. Start with futures positioning. During the sell-off, a massive amount of open interest disappeared from the silver market. That doesn't happen when long-term holders lose faith. It happens when leveraged positions are forced out. When margin pressure rises and liquidity tightens, weak hands don't exit gradually, they're removed all at once. The collapse in open interest confirms that this wasn't a shift in belief, it was a liquidation. And that distinction matters. When prices fall while open interest collapses, it tells you the selling wasn't voluntary. Positions were closed not because traders changed their outlook, but because they had no choice. That's the first major signal that a reset is underway. But here's what they're not telling you. At the same time paper positions were being flushed, physical silver didn't behave like a market that was falling apart. If demand were truly collapsing, physical availability would improve, premiums would fall, delivery times would shorten. Instead, the opposite signals appeared. Dealer premiums stayed elevated, availability remained inconsistent, and in many regions, sourcing physical metal continued to be difficult even as prices were slammed lower on screens. That divergence is critical. Paper markets can reprice instantly, physical markets can't. When futures collapse while physical demand remains firm, it exposes a disconnect that cannot last indefinitely. One side has to adjust. Either physical demand breaks, or paper pricing is forced to reconcile with reality. History shows how that usually ends. Now look at inventory behavior. In genuine bear markets, inventories rise. Metal flows back into the system, supply loosens, stress disappears. That's not what we're seeing here. Inventory data continues to reflect tight conditions relative to historical norms, not extreme shortages, but nowhere near the kind of abundance that would justify panic narratives. That's not a sign of weakness. It's a sign of imbalance. But here's what they're not telling you. Backwardation continues to flash warning signals. In calm conditions, silver futures trade in contango, where future delivery costs more than immediate delivery. Backwardation flips that relationship. It tells you immediate demand is strong enough to outweigh storage and financing costs. That does not happen in markets that are collapsing due to lack of interest. It happens when availability matters. Backwardation doesn't need to be permanent to be meaningful. When it appears during periods of extreme volatility, it reinforces the same message repeated across the data. The problem isn't silver demand, it's leverage. Now widen the lens. Outside Western paper markets, silver hasn't behaved like an unwanted asset. Industrial demand tied to energy, technology, and manufacturing continues. Import activity in major consuming regions remains elevated relative to historical baselines. None of that aligns with the idea that silver suddenly lost its relevance. So why did price behave the way it did? Because leverage failed. And leverage failures don't look like orderly repricing. They look like air pockets, sudden collapses, mechanical selling, and then rebounds that arrive before confidence returns. That's exactly what we saw. Now bring institutional exposure back into the frame. When large banks report stress or losses tied to silver derivatives, it doesn't mean they're being crushed. It means volatility reached a level high enough to surface inside their books. And when that happens, it almost always coincides with forced exits elsewhere in the system. Losses at the top and liquidations at the bottom tend to appear together. That's not coincidence. That's how stress propagates through leveraged markets. Here's the smoking gun. Every major data point points in the same direction. This wasn't a failure of silver. It was a failure of positioning. A forced reset that transferred risk from those who couldn't hold it to those who could. Open interest collapsed. Physical demand held. Inventories stayed tight. Backwardation flashed. Institutional exposure surfaced. Each signal alone raises questions. Together, they form a pattern. This wasn't the end of a cycle. It was the clearing event that allows the next phase to begin. And that leads to the only question that matters now. What happens next? Now that leverage has been reduced, positioning has changed, and the system has proven how fragile it really is. That's where the real risk begins. If you miss just a few key signals in the next phase of this cycle, you won't lose because you were wrong. You'll lose because the rules changed quietly while most people were still looking at old assumptions. And that's exactly where we are now after a violent reset like the one we just witnessed. Markets don't return to normal. They enter a transition phase. Leverage has been reduced, positioning is thinner, and price becomes far more sensitive to imbalance. That doesn't mean collapse is guaranteed. It means the margin for error is gone. From here, there are two broad paths this market can take. In the first scenario, things appear to stabilize. Liquidity improves slightly. Volatility compresses. Price moves sideways or grinds higher just enough to restore confidence. On the surface, this feels like relief. Headlines soften. Commentators talk about healthy correction and normalization. But here's what they're not telling you. Stability does not equal safety. In this outcome, the system isn't healed. It's paused. The same structural pressures remain underneath. Tight physical supply, heavy paper exposure, and a market that already proved it requires force to rebalance. For households, that means purchasing power doesn't magically recover. Savings don't suddenly become safer. Risk is simply less visible. And when risk becomes less visible, people lower their guard. That's where the second scenario comes in. This path is more disruptive, and historically more common after resets like this. In this scenario, physical demand continues to quietly exceed available supply. Inventories don't need to collapse. They only need to tighten at the wrong moment. When that happens, price doesn't move gradually. It reacts. Small triggers become catalysts, a shift in policy tone, stress in funding markets, a change in margin rules, even an attempt to project calm while actions signal the opposite. In thinner markets, those signals don't get absorbed. They get amplified. This is where the public story and institutional behavior often diverge. The messaging stays reassuring, the positioning does not, and that gap is dangerous. What makes this phase particularly sensitive is timing. After leverage has already been flushed, markets don't need big headlines to move. They need imbalance. And imbalance tends to reveal itself suddenly. That's why future moves may arrive without warning, catching most participants off guard. This is also where long-term and short-term perspectives split. Short-term thinkers wait for confirmation. They want clarity. They want reassurance. Long-term forces don't wait. Industrial demand, supply constraints, and monetary pressure continue regardless of sentiment. When those forces collide with a thinner market, the result isn't stability, it's acceleration. That doesn't guarantee direction, it guarantees movement, and movement is what exposes fragility. This is why so many experienced observers aren't asking whether silver is bullish or bearish right now. They're watching how sensitive the market has become, how quickly it reacts, how little pressure it takes to move price meaningfully. That's the real signal. The final piece of this puzzle is understanding why this matters now. This reset didn't happen in isolation. It happened at a point where leverage was elevated, confidence was stretched, and structural pressures were already in place. The violent move wasn't random, it was the system forcing balance. And systems that require force to rebalance don't become stable overnight. They become fragile. So what can you actually do with this information? First, stop thinking in predictions. This phase isn't about calling tops or bottoms. It's about tracking conditions. Watch how volatility behaves. Watch how physical markets respond when paper prices move. Watch whether stress fades or simply shifts. Second, reduce fragility. Avoid overexposure. Avoid leverage traps. Markets like this punish speed and reward patience. Third, prioritize information over noise. Headlines will always lag structure. By the time consensus forms, price has usually already moved. You're not powerless in environments like this. You're just required to be more disciplined. And if this video helped you see the silver market more clearly, like this video and subscribe to the channel because this cycle isn't finished. And the next moves will matter even more. Stay sharp, stay aware, and make sure you're watching before the next shift arrives.